A very warm welcome to all of you. This is John Mihaljevic, and we are excited to have you with us today and tomorrow for Asian Investing Summit 2014. We have quite a few very interesting investment ideas in store for you, and we are very excited for all of the sessions over the 2 days. This session will follow our standard format. Oliver will introduce our instructor, then the floor will be his. We will have a Q&A session following the remarks, so feel free to type your questions into the online interface at any time. The session is being recorded and we'll have it available for replay within 24 hours. Oliver, please go ahead.
Thanks, John. I'm delighted to introduce Seng Chong, Chief Investment Officer of Yeoman Capital Management based in Singapore. I've had the pleasure of learning about investing in Asia from Seng Chong through our conversations over the past couple of years, and you can access the videos of these conversations online. Seng Chong is one of the best deep value investors you will find in Asia, having delivered a mid-teens return to investors going back more than 15 years now. Before founding Yeoman Capital Management in 1999, Seng Chong served in top management of several publicly listed companies in Singapore. And Seng Chong has made use of these operational experiences to avoid value traps and identify not just quantitatively cheap equities, but stocks where management in the business itself can be positives for the investor. Today, Seng Chong will share with us two such equities, and I encourage you to make the most of the Q&A later on, not only to dig deeper into the two ideas, but take advantage of Seng Chong's experience and ask really everything you ever wanted to know about investing in Asia. We truly have a local expert here with us today. And with that, I'd like to turn it over to you, Seng Chong, for your remarks. Please go ahead.
Yes, thank you, Oliver, and thank you, John. Well, good morning to you and good evening to me over here in Singapore, 12 hours time difference. I'm pleased to share with viewers here two case studies for today's conference. These two cases are stocks that we currently hold in our portfolio. In our portfolio, there's a total of 66 stocks today, so these are just two out of 66. My objective is really just to show through these two live cases, stocks that we own and have got foundation criteria met, and how these two ideas actually reflect the larger portfolio and how we position the portfolio in terms of valuation matrices as regards the broader market, how our security selection and how our portfolio construction actually set us up for outperformance against the market over the longer term. Without further ado, I'd like to proceed on to the first slide. Next slide, please, Oliver. Thank you. The first stock that I'd like to share with you is called Tan Chong International Limited. The ticker is TCI space SP or ticker 693 in Hong Kong. The business, it is in heavy commercial and motor vehicle distribution, industrial equipment distribution, and supporting businesses in the area of property rental and property development. The place of listing, the primary listing is in Hong Kong, and the secondary listing is in Singapore. The business model has got a Asia regional reach, and by that I mean Singapore, Thailand, Hong Kong, Taiwan, and the People's Republic of China. The market capitalization is today just under 800 million US dollars. The listing history, as we require a listing history for all our invested companies, is 16 years. It was first listed in 1998 following a restructuring of the Tan Chong group of companies. So we do have a stock with listing history in excess of 10 years over here. Next slide, please. Oliver, next slide, please. Thank you. The valuation ratios at price of Hong Kong dollars, $3, it is, in terms of PE terms, price earning terms, 2.75 times. But if we were to exclude the revaluation gains on properties, the adjusted PE trailing is 6.5 times. The price to book ratio is 0.58 or just under 0.6 times. The dividend yield is 3.17% per annum. It's paid twice a year, and the dividend record is outstanding. It has been paying a dividend twice a year for every year since listing in 1998 without fail. The return on equity, including revaluation gains, is 23%. If we were to exclude the property revaluation gains in the last financial year, the ROE comes down to a high single digit of 8.5%. Next slide, please. Next slide, please, Oliver. Yeah, good, thank you. Now, a comment on the management. I've given you the financial parameters earlier on, but how about the softer aspect, that is the people who sit on the board and who sit on the executive team of the company? Well, we have not met with the company for quite a while now, but we do know from the published financial statements that the director's remuneration is modest, at under 4% of the net profit in the last financial year. And that suggests that management is modest in terms of its demands on salaries that are taken out of companies' pre-tax profit. Over the listing history of the company, there have been no losses, which suggests that the management indeed has got good operational acumen and ability. The balance sheet of the company over its entire listing history has been unimpaired. It's always been in a net cash position, with cash pile growing every year as we speak. Cash aside, the balance sheet book value has grown steadily over the years to the tune of 6 to 7% compounding book value growth. The business footprint over Asia has grown with no diversification. Diversification is a term coined by fund manager Peter Lynch, and this suggests that the company has been focused in its core business. There has been no sidelines which have caused harm to the company. Its earlier core business was the distribution of Nissan motor vehicles in Singapore. They expanded it to cover the Subaru range of motor cars, but the market in Singapore being small and being highly restricted by the government policy requiring certificates of entitlement, the company looked for fresh areas of growth, including the manufacturing and assembly of trucks, FUSO, Fuso trucks in Thailand, and distribution of cars in Hong Kong, Taiwan, as well as industrial equipment, which covers forklifts and other industrial machinery all over the larger China region. Over the 16 years of listing, there have been no dilutive share issues. As minority shareholder in this company, we have not been forced by the company to be diluted down through some actions that are not friendly to minority shareholders. The insider ownership, that's to say the major shareholders, stand at 75% of the company, which suggests that we as minority shareholders are in the company of people who are committed to the business. Next slide, please. Well, the comment that I can make at this stage is that our fund and our clients have owned this stock on and off since 1999. We've known it for a long time. We're familiar with the business. We're familiar with the financials of the business and the character of the people on the management team. The present position that we have in our fund was acquired from 2006 onwards, and we still own the stock today. With that, I'd like to take you on to the next case study, which is Willis Array Electronics Holdings Limited. This stock has been listed in Singapore since 2001 under the ticker WAE space SP. Around about 6 months ago, it initiated a dual listing in Hong Kong under the ticker 854 space HK. When questioned, the management explained that the reason for the Hong Kong listing is so that their customers and business partners in the Hong Kong and Greater China area would be able to access their financials of the Hong Kong exchange, and therefore give the customers greater transparency as well as confidence in Willis Array. The business is in the trading of electronics components. The place of listing was in Singapore for the last 13 years, but in recent 6 months, Hong Kong as well. Geographical reach is Greater China, which suggests Hong Kong, the People's Republic, as well as Taiwan. Market capitalization is at the other end of the spectrum, as compared with the earlier case study that I showed you. It is at US dollars $41 million. Listing history, as mentioned earlier, has been since 2001, or 13 years. Next slide, please. Thank you. The valuation ratios of this stock at price of 13.5 Singapore cents. There's a slight change here in terms of traded price. Today, the stock is trading at 16 cents, but things haven't changed all that much. But you do know the reference is at 13.5 cents for instance. The PE is just under 7 times. The price to book ratio is just under 0.6 times. And dividend yield paid every year, once a year, on a trailing basis is at 7.4% per annum. It's not missed a dividend payment every year except 1 year in 2009 during the global financial crisis, when the company had to clear inventory, take a small operating loss, and only in that 1 year was the dividend payment omitted. The return on equity in the last financial year is at high single digit at 8%. Next slide, please. Next slide, please, Oliver. Next slide, please, Oliver. Okay, good. I got it here. On the management, the director's remuneration is a bit higher than the previous example at 32% of net profit, but that's because the earnings base of the company is smaller. So given the directors on the board, the percentage claim on the profit is a bit higher, but it's still within reasonable bounds in our own assessment. The balance sheet condition has been reasonably maintained. It is a geared balance sheet because it's a distribution business. There's a need to get funding for inventory, for working capital. So it is a geared balance sheet as opposed to the earlier example, which is a net cash balance sheet. But the gearing is reasonably maintained and certainly not stretched in our own assessment. Balance sheet book value has been grown steadily over the years. Again, the management has grown the business prudently in our assessment of its public record without any diversification, a la Peter Lynch. Only 1 year of reported losses, as mentioned earlier. There have been no dilutive issues. Inside ownership, that's the same, the majority share owner stands at 42%. Next slide, please. Well, the manager's comment, that's to say my comment, is that our fund and our clients have held this stock since 2006, and we still own the stock today. Next slide, please. The two examples have been explained to you, but how does that relate to the other aspect of our work, which is the construction of the portfolio, which is positioned for future returns? Well, firstly, the stock valuations, as I've pointed out to you earlier, is comparable to our portfolio valuations, and in some of the areas I would think that the stock valuations are even cheaper than our portfolio weighted average valuation ratios. For instance, on price earnings multiple terms, Tan Chong International commands a PE of 6.5 times trailing. Willis Array is at 6.85 times, whereas our weighted average fund trading PE ratio is at just under 11 times. So on PE terms, these stocks are cheaper. They are value accretive to our larger portfolio. The next valuation parameter on price to book terms, Tan Chong International is at just under 0.6 times, and the same for Willis Array at just under 0.6 times, whereas our fund price to book weighted average ratio is at 0.62 times, so slightly less than portfolio weighted average. In terms of dividend yield, Tan Chong is roughly at the same dividend yield as our portfolio at 3.5%. Willis Array dividend yield is in excess of the portfolio at 7.4% compared to 3.7%, so double the portfolio dividend yield. So again, it adds value, it is value accretive to the fund portfolio as a whole. In terms of the fourth parameter, which is the capital efficiency measure, the return on equity ROE 1 year trailing of Tan Chong is at 8.5%, Willis Array also at 8.5%, and our fund is at 7%. So again, it adds positive accretive effects to our fund portfolio. Next slide, please. Well, I've explained the relationship of the stocks that we choose relative to the fund, but now I move on to explain how the fund, relative to the larger market, is well positioned for outperformance in the days ahead. Our fund is relatively undervalued compared to the market. The MSCI valuation parameters here are taken from the MSCI website in end January of this year, and our fund ratios are based on end February. PE terms, our fund is cheaper than the market. We are at 11 times, the market's at 12 times. In terms of price to book, our fund is at 0.6 times and the market is at 1.47 or nearly 1.5 times. So roughly we stand at 40%. If the market is given a price to book ratio of 1 time, we stand at 0.4 times. That gives us a lot of lift in terms of upside when we use the price to book parameter in isolation. Dividend yield, again, our fund commands a higher dividend yield than the larger market. We stand at 3.7% as compared with the market of 2.5%. So we are in excess of 50%, 50% greater dividend yield as compared with the market. So my last slide, my next slide and my last slide, thank you, Oliver. The concluding remarks I have to make is that the performance attribution, because we don't know the future and we don't know the wiggles and the squiggles that the market will take day to day and week to week, we can only by by sheer strength of our security selection and portfolio construction, make sure that performance will come to our clients and shareholders in this way. Because our stocks selected are undervalued, which makes for a undervalued portfolio, which makes for a portfolio that's undervalued relative to the market. We don't need to emphasize the second item that I've shown here on this slide, market timing. Market timing is for people who know the future. With humility, we admit that we don't know the future, and we don't know the future jiggles in the market may make. The third point here is very important. As we speak, and even tonight, after this conference is over and as I go to bed, I have the confidence and the knowledge that valuation, or better still, undervaluation, is always in our favor. The stocks are undervalued, which makes for an undervalued portfolio, which stands demonstrably, numerically, objectively, undervalued relative to the market. Therefore, we can have that confidence going forward. For the above three reasons, the fourth point, and the point I'd like to conclude on, is that we are therefore able to be fully invested over all market cycles, over all economic cycles, no matter what the prevailing sentiment or market flavor of the month may be, holding little or no cash. So with that, I'm pleased to end my little short discussion here, and I welcome any questions from Oliver, John, and from the audience. Thank you.
Thank you very much, Seng Chong, for those insightful remarks. I would just like to remind everyone that if you have a question, you're welcome to type it into the online interface. As we compile the queue, I already see a couple of questions that have come in. I want to go to Oliver to get us started with the queue. Oliver, please go ahead.
Seng Chong, thank you as always for your thoughts. It's very instructive. As you went through your remarks on the two companies, what stood out to me was just how methodically you go through the various important considerations, whether it's the listing history, the insider ownership, and some of the other factors that are clearly common among the way you discuss both ideas. I'm curious for investors sitting in New York or London, or for that matter not being very familiar with Asian markets as you are there locally, and with your experience, how should one think about some of these factors that really present no opportunity to compromise for you? So in other words, which factors do you look for that would disqualify you to include an idea in your portfolio, perhaps that has to do with some peculiarities about Asia, in order to avoid the quantitatively cheap stocks that can represent value traps?
Yes, sure, Oliver. I understand that question very well. If you could just help me perhaps up the slides back to 2 or 3 slides earlier, please, could you? Could you return to Willis Array, perhaps? Aha, good. This is very good. Here we start with what is numeric and therefore should be objective. Objective to a trained eye, to a disciplined eye. Objective when your methodology is properly established. I think firstly, the numeric ratios and numeric parameters must make the investment justifiable. If this particular stock, Willis Array, it's single-digit PE, it was high double-digit PE, it would disqualify this idea. I won't be talking about it today. If the price to book, well, if the price to book was 2 times, 3 times, I won't be talking about it today, and more importantly, I won't have it in our portfolio, but it just happens to be at 0.5, 0.6 times today. For me, as a first cut, anything that's in excess of 1 time price to book, I would really frown. I would tell my guys, look guys, do we really have to go above parity and price to book? if my guys can give me a good reason, because there are other countervailing reasons, strength of business, demonstrated long-term, sustainable ROE, cash generative, blah, 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 I might accept their explanation and allow them to pursue a idea in excess of 1x price to book. But as a first cut, below parity price to book is a nice, gives me a nice warm feeling in the stomach as we speak. Dividend yield, if there's no dividend yield, my goodness, if there's no dividend payments, or worse still, if there are cash calls and there are dilutive issues, which is going to be discussed in the next slide anyway, these are negative dividend yields, as I say, we pay dividend to the company. That would disqualify the stock. And of course, back to the question of value trap, if the ROE was negative or zero or sputtering 1 year, positive 1%, next year negative 1%, those would be would clearly clearly signal value traps, and those who would avoid. So on a numeric basis, stocks that are overvalued, PE, PB, dividend yield, or ROE which suggests poor capital efficiency, we would avoid. Next slide, please. Yeah, that's right. Thank you, Oliver. Well, moving away from the numeric, but still numeric in some ways, if directors' remuneration was excessive, say for this particular case, if directors' remuneration was 80% of company net profit, perhaps in a year when the company earnings take a dip, and for that reason you cannot cut the pay of directors, for that 1 year, for that 2 years, for a short time, if the director's pay is relatively high, I suppose we can forgive that, but in a normalized year, director's remuneration should not take up a disproportionate amount of the company net profits, because we are investing in this company not to feed the directors, but to feed, well, not ourselves, but our shareholders. Balance sheet showing gut-wrenching ebbs and flows. 1 year balance sheet is in black, next year it's wiped out, has to go for recap. Those companies would be a no-no. But there's no balance sheet growth, third point here. Balance sheet growth links back to the previous slide where there is a underlying ROE. There must be balance sheet growth if the stock being evaluated is not a value trap. ROE would lead, underlying ROE, sustainable ROE would lead to balance sheet book value growth over a period of time. And maybe here, the emphasis here is on over a period of time. Too often, people on the sell side, on Wall Street, may point to an amazing ROE, but it's a 6-month trading, annualized ROE, or the last 1 year trading, but all the years before that have shown ghastly ROE or ghastly balance sheet condition. Those things don't count. Those cases, we would throw it out of the window upon initial sighting. Businesses that stay focused, fourth point here, no diversification on a Peter Lynch, that would be a requirement. And again, the fifth point as regards reported losses, I mean, we can tolerate, 1-2 periods of reported earnings losses if there are reasons surrounding the issue, such as what took place with this particular stock during the global financial crisis. But a patchy earnings history is symptomatic of either weak business or weak management, both of which would make it uninteresting for ourselves and our shareholders to invest. Dilutive issues, I've talked about this before. There's a song by Paul Simon, Sliding Away. Well, dilutive issues are situations where we as minorities will be sliding away all the time. And again, back to the interview that we did about a year ago, Oliver, we relish the prospect of being co-investors with insiders or major shareholders that are strong in the company. Then we know that the stock that we're in are not nobody's child situations where nobody wants them. Okay, back to you, Oliver. Thank you.
Well, thank you very much, Seng Chong. You mentioned a very important word, objectivity, in the way you assess these situations and looking for factors that can be objectively assessed. When it comes specifically to the issue of management and getting comfortable with the controlling situations that one often finds in Asia, can you perhaps just point to a few of the key objective ways to assess a management team and get comfortable with owner-operators in Asia? What would be some of your favorite objective factors to look for, and which factors do you think investors pay too much attention to and you would consider more subjective and therefore less relevant to a methodic, even scientific analysis?
Sure, I understand your question, Oliver. Perhaps if I can start with the second question first before I go on to the first. Subjective way, as explained earlier, is to require meaning and to feel that warm glow in your heart, in your stomach, when you look at the founder in the eye and he preens himself and he praises you. I think that would be a bad way. The objective way is as explained on this slide before us right now. When we assess management, when we use these criteria that are now before your eyes, I think that these facts can be extracted from the listing history and the audited financial record of the company. What we see before us on this very slide on management are the objective factors that we will pursue. It's very hard for funny management. When I say funny, I mean really funny. It's very hard for funny management to disguise under the mask their actions and their intentions. If a company has got listing history in excess of 5 years, they may be able to keep up the song and dance for a year or 2 or 3. But with long listing history, minimum 5 years, better still 10, better still 15, it makes it hard for funny management to disguise their aspirations and intentions. I hope that clarifies, Oliver. Yeah, John, back to you.
Yes, thank you, Seng Chong. And before I turn it over to John for questions from the audience, just one last one from me. I noticed that both of these businesses, in a way, are trading distribution businesses, and I'm wondering whether that's important in your search for the right opportunities in Asia. Give us a sense of the types of businesses that you have found to be quite fruitful investment opportunities for you over the years. Is there anything that you have learned over the years, which types of businesses to avoid in Asia?
Okay, good question, Oliver. When we prospect for stocks in the Asia ex-Japan or even the Japan domain, and I should add that we have a separate dedicated Japan fund now. What I'm sharing with you today is from the Asia ex-Japan fund. We find that when we are demanding on the Graham and Dodd net requirement, we find that nets don't occur in certain industry types. We find that nets abound in Asia with manufacturers, with distributors, in some cases service companies, say logistics, say engineering consultancy. In some cases, maybe with some undervalued property developers, sometimes property investment property or investment property companies. Once we move away from these business model types, once we have financial institutions, whether reinsurers, whether insurers, whether banks, especially regional or global banks, we find that balance sheet clarity can define us. I mean, for the team and myself, we're a small team. We don't cover one stock our entire life. We have to cover 66 stocks stocks in the portfolio. Not only that, we have to be always prospecting for new ideas for the portfolio once the 66 stocks meet their valuation levels. We find that financial institutions do not suit an efficient scaling up of the investment portfolio for our present staffing and size of fund. And I was thinking, even if we were to double or triple our fund size, I would think that this would change for ourselves. So opaque balance sheets that are not very transparent, takes too much time to dissect. I'm not saying that they are uninvestable. I'm just saying that they take too much time and effort to unravel. So that's one. And then there are other cases where not only does it take time and effort to know, but there are many other situations where no matter how much effort you expend, the real balance sheet condition cannot be properly known. Obsolescence, technology obsolescence, high capital consuming business model types. No surprises, we don't have any airline stocks in our portfolio. We have no semiconductor foundries. We have no social media stocks in our company. No internet stocks in our portfolio. So, as focused, value investors working the ground that we do over here, we will pick our battles very selectively. We will pick the battles where we can punch once, twice, and win. We will not get into a stalemate and come out missing a leg or an arm and cause great harm to people that rely on us, namely our clients and shareholders. Okay, back to you, Oliver, John.
Well, thanks so much, Seng Chong. I want to turn it over to John at this point for questions from the audience. John?
Thank you very much, Oliver. There are quite a few questions. I'll just go down the list. If a company is dual listed as these are, what factors would you look at to decide which market to buy the shares in? And maybe related to that, could you also comment on Western investors, whether they should look for local execution or a brokerage partner, or whether Western banks are very present as well?
Sure. Thanks, John. I understand that. Well, the first question first, let's say which exchange to buy it on. We would, we take the view that, or at least I take the view that the stock market is just a convenient point for transacting, making transactions, whether to buy or to sell. There's no merit one stock exchange over the other. In the case of, well, these two cases has happened to be dual listed, right? Willis Array was actually single listed until 6 months ago, whereas Chong primary listing has always been in Hong Kong with secondary listing in Singapore. But interestingly enough, liquidity on the Hong Kong exchange is a lot lighter. There's a lot more liquidity in Singapore. So depending on the price on any given day, on my stock screen, I've got both the Hong Kong as well as Singapore transacted prices and then the bid offers on both sides. Well, I think you know the answer to this question. Which exchange should we buy it on? Where it is cheaper, where we get a lower price, we'll buy it on the exchange, and where there's liquidity, we buy it on that exchange. In terms of governance, the primary listing takes precedence over the secondary listing. So we do know that when things do go wrong, nothing has gone wrong in these two cases, but if things do go wrong in the case of primary versus secondary listing, we as investors will have to seek recourse in the primary listing domicile. So if anything was to go wrong with Chong, we would have to seek redress through the Hong Kong Stock Exchange and not through Singapore. But we're not with great privilege, we say that nothing has gone wrong with both these situations so far. So that's it. The answer to your question, short and simple, is we buy on an exchange where it's cheaper and where liquidity allows us to get the size that we need for that one day or that 1 week. Now, in terms of execution, this is the second question, John. I would say that like the exchange, like the stock exchange before you, I would think that in my experience anyway, that any stockbroker that's able to provide you the service at a competitive cost would be worthy of consideration. Most importantly, I would say make sure that the custody arrangements do not commingle these stocks with the institution's own proprietary positions, that you own these stocks and these are held in your own account, segregated from the stockbroker or the bank's own proprietary holdings. Okay, I hope that helps. I believe that's all that there is to it, really. Okay, back to you. Back to you.
Yes, thank you very much. Question, yes, question on Chong. Could you talk about the makeup of their asset base and how much of it relates to real estate?
Yeah, this is very interesting. Chong is a wonderful case of how when you look at a stock that's trading at a price to book of 0.6 times, when you go through the annual report line by line and look at the dates for the valuation of the assets on the balance sheet, it makes for very, very exciting reading. It's almost like a detective novel. The balance sheet of Chong has got inventory, which comprises industrial machinery that have just been manufactured, comprises Nissan cars in Singapore, Subaru cars in Singapore. These are all inventory that are out for sale. It also has, of course, for the plant in Thailand and some of the assembly plant in China for industrial trucks and industrial equipment. There would be work in progress. There would be inventory parts and parts for production purposes. There will also be property, plant, and equipment for the manufacturing and distribution aspects of the business. Property would be the premises for their warehouses, the showrooms for the Nissan cars in Singapore. The development properties, Chong does develop and sell residential houses using the historical land bank. Development properties are carried at present market value, so there's no hidden valuation reserve here for development properties. For the property, plant, and equipment, I can share with you today, and if you wish, all of you out there can get a copy of the latest annual report. It would show that the showroom in Singapore is carried at historical book value. So there is some there can be some mark-to-market gains here if this property is ever, there's no plans for it right now, but if this property was to be sold and the showroom was to be moved to another location, they would have to spend money for that new location, but certainly they would get present-day market prices for their premises where they are at the showroom today. So that's it. Well, that's what you have. Huh? You've got inventory, you've got work in progress, you've got parts for manufacturing, you've got property, plant, equipment, you've got development properties, which are marked to present-day market value. Okay. So that's Chong. Did I answer your question completely?
Yes. Thank you very much.
John?
There is a question or a couple of questions that are somewhat related regarding your fund's ownership history of Chong. The one question relates to what made you decide to sell the position? You've owned it on and off, so at what point do you decide that it's no longer a good hold? And the second question relates to the listing history. You may have mentioned you like to see 10 years of listing history, and is that a new criterion for you? You've owned Chong since 1999 on and off.
Yeah. Well, 1999 is a long time ago. I was a young man then, and being young, I was a little bit more headstrong, but I wouldn't think that I was foolishly headstrong. When Chong was listed in 1998, it was the result of a restructuring by the Chong family. In the past, they had operations in Malaysia and Singapore as well, but resulting from a restructuring of the family holding structure, the Hong Kong listed vehicle came to life in 1998. But the underlying businesses and the underlying business history of the company predates 1998. So it's a company with a long history of doing business in Singapore and Malaysia. So although Chong International was freshly listed in 1998 and we came in 1999, and 1999, my goodness, as we speak, is 15 years ago. We were young and headstrong and probably not as wise and battered by life experiences as we are now. But even then, young though we weren't foolishly so. At that time, there was a very strong undervaluation case. The stock price, I should share with you that the stock price back in 98 was, we started buying at 25 cents Hong Kong cents, 25 Hong Kong cents, as compared with today's traded stock price of $3.20. So at 25 cents from that time, if we had held on all the way through, you can imagine for yourself, you can calculate for yourself what kind of return we would have got. So it was very, very cheap. And secondly, although new listing, there was actually a history predating the listing. So it was just a matter of rebundling the business following the restructuring of the family holdings that led to the Hong Kong listing. Today, as we speak, there are three, again, legacy Chong companies listed on the Malaysian Stock Exchange, and they are Warisan, Chong Motors, and APM Motors. APM Motors does auto parts. Chong Motors again distributes Chong cars. Chong International doesn't participate in the Chong distribution in Malaysia. It is the sole purview of the Malaysian listed Chong company. And Warisan is a company that distributes forklifts, does forklifts, healthcare products, and forklifts, healthcare products, and undergarments, intimate undergarments, ladies at the end. So that's whether the Malaysian listed companies today, whether Chong International listed in Hong Kong and Singapore, these are operating businesses with long-established ownership by the Tan and Chong families. Indeed, these are some of the dynastic corporations in Singapore and Malaysia. So I think you can forgive us that we didn't religiously stick to our script back in '99 because we were young and a bit more headstrong, but more importantly, the underlying case in terms of business history and undervaluation was there even as we activated it in 1999. Does that answer your own? Did I miss anything there, John? Sorry.
Yes, thank you. That is very clear.
John, did I miss? Yeah, I hope I didn't over talk. I mean, I know these companies so well. I mean, it's like I would consider it next to I would say family, but we know them very well. And not the people personally, but certainly the businesses and how the businesses operate in Malaysia and Singapore and Hong Kong. We have a certain level of rapport with the company. Yeah.
Mm-hmm.
Okay. Go ahead, back to you, John.
Yeah, related to knowing these companies very well, could you perhaps talk a little bit about why you believe they are so cheap, especially on a price-to-book basis? And do you see any catalysts that could make them trade closer to fair value?
Yeah, it's very interesting. This is always a perennial question that growth investors and value investors ourselves would lock horns, and never the twain shall meet. Growth investors will, we will explain the undervaluation. Growth investors will explain away the undervaluation. We will say that there is potential in these in terms of upside. They will say that there's a reason why it's so cheap, and those reasons will continue to dog you. So the two schools of thought, the growth people and the value people, we will never ever meet because these are two opposing camps. But if I may take on a contrarian stance or a devil's advocate stance or a black hat stance, I think firstly we know from the work done by academics, whether it's Graham and Dodd, whether it's Dr. Farmer, Dr. French in today's situation, we know that value outperforms growth over the longer term overall market cycles. And the reason why value outperforms growth is very clear, that we take positions and we believe in stocks when the undervaluation is there and the price is cheap, and we take action, whereas the growth people will walk away disenchanted and they will focus on other things, maybe social media, maybe technology, blah blah blah. So that's fine. It gives us opportunity. There's another point to comment, and that is that we don't really have to, as investors, we don't really have to put that heavy moral and emotional burden on ourselves. It's cheap for a reason. It's cheap for a reason. It's cheap for a reason. We keep criticizing and we keep castigating ourselves. If we do that, we would be psychologically unable to stay the course, and we would probably not reap the full rewards of the exercise of investing the way we do. So don't put yourself into a position of psychological weakness by saying it's cheap for a reason, because this is the mantra adopted by the other school, the other camp, and we don't need to follow them. Let them, we wish them well, but we don't have to follow them. Now, the third point on triggers and re-rating, I can probably answer your question in two ways. That's to say that when we invest in a stock, we can see some areas of potential re-rating and value unlocking. Some value unlocking avenues we can suspect or see or picture in our mind's eye. But I should also be humble and let you know that there are many other areas for value unlocking that we don't know and don't see, but it happens anyway. In summary, I'd like to point out that when our stocks are undervalued relative to portfolio, but portfolio is undervalued relative to market, as we go about our day-to-day, there will be intelligent investors, bigger than ourselves, whether it's in the form of a private equity investor, or whether it's in the form of a real business acquisition, or whether it's true the market re-rating by a whole swathe of investors not known to us as John or Oliver or Seng, Chong or Peter. They have no names because it's the market, and the market moves where there is undervaluation. I like to believe that when we sit on the side of undervaluation, kinetic energy in terms of price movement is not evident, but potential energy in terms of stored reserve, like a spring that is coiled, ready to burst, but with each passing day, if price does not re-rate, but if the ROE keeps chugging along over a month, over 6 months, over a quarter, over a year, the compression in the spring and hence the stored energy will uncoil at a time that we don't know. But when it does uncoil, all the months and years that we spent waiting will not be in vain, because the rating is a point function. Valuation is a point function. When you're sitting at point A at this particular price, when it re-rates, it will go to point B or C or D, and that price doesn't have to necessarily follow your line at an incline of 8% or 5% a year. It doesn't have to. Re-rating can be sharp, pleasant, and sudden, and it's a point function, not a line function. So do not be deceived. When we invest the way we do, nothing will go to waste. Back to you, John and Oliver.
Thank you very much, Seng Chong. That's very well said. We are almost out of time. I did want to just squeeze in one specific question that we received on WAE.
Sure.
The questioner says, looking at Bloomberg data, the past 5 years, free cash flow has been up and down, perhaps even negative in a couple of the years. Could you comment on the volatility in the free cash flow there?
Yeah. Sure, thanks very much. It's a good question, and this is where I suppose it is a when the analyst team and myself decided to buy the stock portfolio for our clients, we have to address this idea of fluctuating earnings, reported earnings, or fluctuating cash flow. The reality in life, whether you are an oceanographer, whether you study tides, coastal and ocean tides, or whether you're a biologist, or whether you're a medical doctor, you study human hair growth, the reality is that tides do ebb and flow. Even hair growth and nail growth on your fingernails, it does ebb and flow. The reality of the natural world in which we live is that nothing is a steady 10%, nothing's a steady 20%. There is undulation in the natural terrain, and similarly, if we were to study real businesses, they should, in most cases, be governed by the cycles of ebb and flow and undulation which the natural world observes. The key question that we as value analysts have to address is that ebb and flow and cycles and volatility aside, are we better off today compared to a point in time in the past? And at that point in time in the past, are we better off than an earlier point in time in the past? Don't forget, when we made the investment into this stock in 06, we only had the history from 01 to 06 to look at. Today, in 21-4, I can not only study the track record from 06 to 21-4, but I also have the benefit of the track record from 2001 to present day, which is 13 years. So over the time past, 8 years in the case of our ownership, 13 years in the case of the listing history of the company, we need to assure ourselves that the quarterly or the annual undulation and ebb and flow aside, are we better off today than what we were 8 years ago, and 4 years ago, and 3 years ago, and so on and so on. And the answer is, tangibly for me, for us, whether in terms of dividends received in cash form, or whether in terms of the under balance sheet book value growth, we are of the view that we are not sliding backwards. Okay, I hope that answers the question there, John.